I will delete this file in 20 minutes. Not because it's classified, but because after this, you won't be able to say you didn't know. At 4 in the morning, when the office is still dark and the cleaners have already left, JP Morgan's servers are running as if a war has begun. Not an outage, not a test. Real load. I wasn't looking at stock charts or press releases. I was looking at an internal exposure table. And when I reached the final line, my mouth went dry. Not from fear, from clarity. $600 trillion. Not market cap, not assets, not equity. Derivatives, notional. A number so large the brain refuses to process it. So the system does what it always does. It divides. It says, it's netted. It's hedged. It's distributed. But when I scrolled further and saw the ratio to the balance sheet, the illusion collapsed. Exposure more than 20 times total assets. 20. That's not risk. That's a structure that only survives under one condition, that nothing goes wrong. The trading floor was silent in a way that has nothing to do with an early morning. No talking, no jokes. People stared at their screens like surgeons before an operation where the patient is already dying, but technically still alive. Cursors blinked with delay. Terminals froze for fractions of a second. And those fractions mattered more than any headline. Because they meant one thing. The system was recalculating, urgently. Correlations, margin, counterparties. When the derivatives machine starts calculating too fast, something has cracked. I remember report 404B, not the one regulators see, the internal one. There were no words like crisis or threat, just sterile language, stress scenario update. Inside it were scenarios no one discusses out loud. Sudden spread expansion. A major counterparty failing to perform. A chain reaction of margin calls. And next to it, a note that stopped everything cold. Liquidity assumption invalid. That was the moment I understood this was no longer about money. It was about time. Why did derivatives grow this large in the first place? Because they're convenient. They let banks earn without holding assets. They let risk be moved without being removed. They create the illusion of control. Each contract looks safe. Each trade looks rational. The problem is that individual safety does not equal systemic safety. It's a reactor where every valve works perfectly, but the core is overheating. The cynical math is simple. Derivatives grow faster than the real economy because they have no physical constraint. They can expand endlessly as long as there is trust and liquidity. Banks earn fees. Traders earn bonuses. Regulators receive reports that look complex and reassuring. Everyone is satisfied, as long as correlations behave normally. But correlations are not laws of nature. They are agreements made during calm periods. I saw the loss modeling for when that agreement breaks. It didn't look like a single-day crash. It looked like a sequence of technical failures. One counterparty asks for more time, then another. Then the clearinghouse raises margin requirements. Banks are forced to sell liquid assets to meet calls. Prices fall. Volatility rises. New margin calls follow. Suddenly, the problem is no longer one bank. It's the settlement system itself. And this is where the loop locks in. Rising volatility increases margin requirements. Higher requirements force asset sales. Sales increase volatility. Increased volatility raises requirements again. The loop closes, and no amount of diversification helps, because everything that can be sold quickly gets sold. In these moments, assets become correlated not because they are economically linked, but because the same people are selling them for the same reason. Why is this too big to bail? Because scale has changed. In 2008, governments could print enough to plug the hole. Today, the size of the derivatives market exceeds the capacity of any fiscal system. Even trillions won't cover obligations measured in hundreds of trillions. You can flood a fire with water. You cannot flood an ocean. I've seen the internal discussions. They don't sound like panic. They sound like engineers talking about an overheating reactor. Can it be isolated? Which circuits do we shut down first? What can we sacrifice? That is more frightening than shouting, because it means a decision will be made about who does not get saved. And that decision is never based on fairness. It's based on systemic importance. The most dangerous illusion is the belief that derivatives offset each other. Yes, on paper. But in reality, offsetting only works with liquidity and trust. When trust evaporates, netting turns into chaos. Everyone demands performance on their contract, immediately, in full, in a system built on deferred settlement chokes. I watched how people change in moments like this. Traders stop looking at P&L and start looking at limits. Risk managers stop arguing, they just cut. Credit lines vanish without warning. Old agreements evaporate because agreements are a luxury of peaceful times. And here's the final deception. The public is told this is technical. It's a complex market. You wouldn't understand. And that's true, most people don't understand it. But understanding and feeling are different things. You won't feel this through the word derivatives. You'll feel it through unavailability, through freezes, through delays, through strange failures in systems that worked flawlessly for years. 600 trillion isn't debt, it's promises. Promises to pay under certain conditions. And the problem isn't that all those conditions will happen at once. The problem is that only a few need to happen for the chain to start tearing. And derivative chains are built so that a break in one place propagates instantly. When I left this system, people told me I was exaggerating. It's always been this way. Markets manage. Yes, until the system becomes larger than reality itself. Now it is. And this is no longer ideology or politics. It's financial physics. If you think this is one bank's problem, you don't understand the architecture. JP Morgan is a node, not the only one, but a critical one. And when a node with this level of exposure starts to wobble, the question isn't whether it survives. The question is which parts of the network will be cut to save the rest. I'm not saying this happens tomorrow. I'm saying the conditions already exist, and every day the derivatives market grows faster than the real economy, the structure becomes more unstable. This isn't a prediction, it's an observation. The most dangerous moment in such systems is the calm before the recalculation, when everything looks fine because nothing has formally broken yet. But inside, processes are already running that cannot be stopped without an external shock. And when that shock arrives, everyone acts surprised, as if this could not have been foreseen. That is the derivatives bomb. Not because it explodes with a loud bang, but because when it starts working, you won't have time to understand what's happening. There will only be impact, and here the road splits into 3 paths, and all of them lead into the same narrowing corridor. Not because the destination is hidden, but because the walls are already moving. After the exposure tables, after the quiet recalculations, after the realization that 600 trillion is not a number, but a condition, the system does what it always does when physics starts to intrude on finance. It tells itself a story that buys time. In the first version of that story, the one designed to keep the lights on and the screens calm, nothing dramatic happens. Volatility rises and falls like a fever that breaks on its own. Regulators issue reassuring statements about capital buffers and stress tests. Executives talk about diversification and netting. A large counterparty stumbles, but it's absorbed. Liquidity lines are extended quietly. Central banks adjust facilities that only specialists read about. The market breathes out. Commentators say the architecture held. And technically, they're right. The structure doesn't collapse, it flexes. But flexing has a cost. In this version, the price of survival is opacity. More trades move off-screen. More terms become bespoke. More risk is warehoused where it can't be seen. Margins are raised not once, but permanently. Collateral becomes stricter. Access narrows. The system survives by becoming less open, less forgiving, more selective. It still works, but it works for fewer participants. Most people don't notice because prices still print and accounts still settle. The damage shows up later, as a loss of spontaneity. The market stops being a place of discovery and becomes a place of maintenance. Then the narrative drifts into the version that feels more honest, because it explains the friction people start to feel. In this version, stress doesn't resolve. It migrates. A small shock here, a missed settlement there. Clearinghouses tighten rules again. Dealers pull back from making markets that used to be routine. Bid-ask spreads widen at odd times. Liquidity becomes time-dependent. You can trade, but only when the system feels comfortable. Outside those windows, it's expensive or impossible. Banks respond rationally. They shorten tenor. They reduce gross exposure. They prioritize clients who can post pristine collateral quickly. Risk doesn't disappear. It's concentrated. And concentration always looks stable until it doesn't. The derivatives machine keeps running, but it runs hotter. Each new contract assumes yesterday's correlations. Each new hedge assumes tomorrow will look like today. Meanwhile, the real economy slows just enough to make the mismatch visible. Growth disappoints, revenues flatten. The promises embedded in those contracts start to feel heavier. And then there's the third path, the one the models struggle to simulate because it requires a behavioral shift, not a numerical one. In this version, a trigger arrives at the wrong moment. It doesn't have to be exotic. A sudden rate move, a geopolitical flare-up, a large fund failing to meet margin on a quiet afternoon. The system tries to respond as it always has, but this time the response amplifies the shock. Margin calls cascade faster than assets can be sold without collapsing prices. Netting assumptions break because counterparties stop trusting each other's ability to perform. What was supposed to offset becomes a demand for immediate settlement. This is when the phrase, too big to bail, stops being rhetoric and becomes arithmetic. Governments can provide liquidity, but liquidity doesn't fix solvency when obligations are interlocked across hundreds of trillions. Central banks can open windows, but windows don't replace confidence. The problem isn't a lack of money, it's a lack of time. The system needs hours, the shock moves in minutes. If you want to know which path we're actually on, don't listen to official statements. Those arrive last. Don't stare at index levels, they lie by omission. Look elsewhere. Look at bond yields where the curve does things that don't match the script. When long rates drift higher, even as growth weakens, capital is demanding protection against something it can't name publicly. Look at collateral rules. When what was acceptable last quarter suddenly isn't, stress is being priced in silently. Look at settlement fails and how often deadlines are extended without explanation. Look at the behavior of clearing members who stop taking new risk, not because they can't, but because they choose not to. Don't watch the news. Watch the plumbing. Watch repo rates when they spike at odd hours. Watch cross-currency basis when it widens without a headline. Watch which assets are quietly excluded from eligibility lists. Watch which desks go from aggressive to absent. These are not coincidences. They are early warnings that the machine is being throttled to keep it from tearing itself apart. And while you're watching, understand the rule that governs every crisis of scale. The system preserves itself by sacrificing optionality. It narrows choices to slow motion. It prefers controlled damage to uncontrolled failure. That means some trades will not be honored on time. Some assets will not be liquid when promised. Some counterparties will discover that agreements written in calm times are flexible in stress. So what do you do when you realize you're living inside a structure whose size exceeds the reality beneath it? You stop assuming rescue is symmetrical. You stop assuming that because something is important, it will be saved in the form you expect. Bailouts don't restore the past, they redraw the map. They decide who continues and who is folded into someone else's balance sheet. Practically, that means thinking in layers. First, remove dependency on continuous liquidity. Anything that requires daily refinancing is fragile. Second, reduce exposure to promises that depend on many intermediaries behaving perfectly at the same time. Third, prioritize assets and positions that settle quickly and clearly. Not because they earn more, but because they fail more slowly. Keep cash, not as an investment, but as a buffer against forced decisions. Cash buys time when others are being told to sell now or default later. Keep something tangible that does not rely on a counterparty's ability to perform at precisely the wrong moment. Not because it will spike, but because it sits outside the netting machine. Reduce leverage ruthlessly. Leverage turns volatility into commands. Without it, volatility is information. This isn't a call to hide or hoard. It's a call to respect scale. When promises dwarf assets by an order of magnitude, stability depends on belief. Belief is a weak foundation. It holds until it doesn't, and when it breaks everywhere at once. At the end of this road, no matter which version dominates, there is a philosophical line you can't avoid. The line between trusting abstractions and accepting limits. Saying yes to the abstraction is easy. It's comfortable. It lets you believe that complexity equals resilience. Saying no is harder. It means accepting that some systems grow beyond their capacity to be controlled, and that participation in them carries risks that cannot be hedged away. The right to say no doesn't come with applause. It comes with responsibility. Responsibility to see beyond assurances. Responsibility to act before permission is granted. Responsibility to accept that being early feels lonely and being late feels expensive. This is not about fear. Fear makes people freeze. This is about alignment with reality. Aligning your exposure with the simple truth that when the notional world grows faster than the real one, the adjustment will not be polite. It will not arrive with a countdown. It will arrive through friction, delays, and choices removed. The derivatives bomb is not a metaphor. It's a condition created by scale, speed, and belief. You don't need to predict when it detonates to understand how it changes behavior now. You only need to decide whether you will wait for the recalculation to force your hand, or whether you will choose your position while choice still exists. Once the system starts deciding for you, it will call that stability. It will call it necessary. It will call it temporary, and it will move on. What you do before that moment is the only part that remains yours.